Every single major XRP price prediction from 2025 was wrong. Not slightly off, not close but no cigar, wrong. And I'm not just talking about the fringe voices, the anonymous Twitter accounts, or the guy with 500 followers posting charts at 2 in the morning. I'm talking about YouTube channels with hundreds of thousands of subscribers, dedicated XRP analysts posting daily content, and yes, one of the largest banks on the planet with a full research desk and a team of credentialed analysts publishing formal price targets. Every single one of them missed. And before you assume I'm standing here pointing fingers from some clean position, let me be the first to put myself on the list. I called $5 to $30 for XRP in 2025. XRP never even broke $4. So this video includes me, full stop. Here's what actually happened. XRP entered 2025 trading somewhere between 2 and 2.30. The SEC lawsuit cloud had partially lifted. Institutional interest was building. The macro narrative was overwhelmingly bullish, with a new administration coming into Washington. XRP rallied through the summer, and in October of 2025, it hit approximately $3.84, a new cycle high. The community was electric. Channels were screaming $5, $10, $20, and then it reversed, hard. XRP crashed approximately 60% over the following months. By early 2026, it was sitting around $1.40. That's the reality. $3.84 at the peak, 60% down, $1.40 today. Every prediction in this video gets measured against those three numbers. Now let's go through them, starting from the most extreme and working toward the most accurate. A daily XRP podcast channel with over 118,000 subscribers revisited a well-known community theory in June of 2025, projecting that tokenized assets, reserve currency status, and institutional supply removal could drive XRP to $20,000 per coin. $20,000. For context, that price would require a market cap of approximately $2 quadrillion. That is larger than every financial asset on Earth combined. Every stock, every bond, every real estate holding, every derivative contract, combined. XRP at $20,000 would need to be worth more than everything. That's not a price prediction. That's a mythology dressed up in a thumbnail. Moving down the list, an XRP-focused channel with 137,000 subscribers published a video in May of 2025 titled, essentially, $10,000 is actually possible. They cited comments from Ripple's CTO about efficiency at that price level within 24 months. XRP peaked at $3.84. $10,000 would require approximately $1 quadrillion market cap. 1 quadrillion. That's 1,000 trillion for a single asset. The math does not exist in any verifiable framework of modern financial markets. Next up, a dedicated Ripple and XRP channel with 169,000 subscribers published a thesis in January of 2025 projecting XRP at $8,162, at which point, they argued, Ripple would become the most valuable company in the world. They also predicted $450 in Q1 of 2025 and a new all-time high by May. XRP was trading around $250 in Q1. It didn't touch $450 until months later, and $8,000 per XRP would require a market cap exceeding every publicly traded company on the planet. Wrong across 3 separate sub-predictions within the same video. Now here's where it gets more serious, because the next prediction didn't come from a YouTube channel. It came from Standard Chartered, a $700 billion global bank with a formal digital assets research division. Their head of digital asset research published a roadmap in April of 2025, projecting $5.50 by year-end, $8 by end of 2026, and $12.50 by 2028. XRP peaked at $3.84 and ended 2025 somewhere around $1.84 to $1.90, off by approximately $3.60 on their year-end target. They were wrong. But here's the critical distinction. When reality diverged from their model, Standard Chartered adapted. They revised their 2026 target down 65% from $8 to $2.80. They didn't pretend the miss didn't happen. They updated the framework. That intellectual honesty matters more than most people realize, and we'll come back to it. Then there's the largest crypto education channel on YouTube, 2.7 million subscribers, publishing in April of 2025 that $5 was the minimum target for XRP, with a possible wick to 6 or 7. XRP never touched 5, ended 2025 well below the minimum, off by 25% on the peak, 60% off on year-end price. Now here is where I want to be completely transparent about something. The analysis inside our own research program was tracking the Fibonacci extension on the 2-week week chart throughout late 2025. The internal target was the $4 level, the most technically justified resistance based on the structure at the time. XRP peaked at 384. That's approximately a 4% miss. Of everything tracked for this video, every public YouTube channel, every research desk, every bold prediction, the closest technical call came from behind-the-scenes work that was never published as a hot take in a thumbnail. But even that closest call was still technically wrong. And more importantly, we did not build our client strategy around that number being right. That distinction is everything. Because here's the part that actually changes how you should think about this asset and this market going forward. In October of 2025, Bloomberg intelligence analysts Eric Balchunas and James Seyfarth published a specific prediction. Not a price target, not a dollar figure, a probability. They said there was a 95% chance that spot XRP ETFs would be approved by the end of 2025. Their framework was built on SEC filing analysis, precedent from the Bitcoin and Ethereum ETF approval processes, and the regulatory trajectory under current SEC leadership. What actually happened? Spot XRP ETFs were approved and launched in November of 2025. Canary Capital's fund went live on November 13th with record first-day volume. Bitwise followed on November 20th. By late November, 5 to 7 spot XRP ETFs were fully operational. Cumulative inflows crossed $1 billion by mid-December. Timeline accurate, outcome accurate, scale accurate. So ask yourself the most important question this video raises. Why was the only correct prediction not about price? Why did every prediction from $5 to $20,000 miss? And why did the one prediction focused entirely on infrastructure and regulatory mechanics play out almost perfectly? The answer is this. Price predictions fail because they are built on narrative and on what people want to happen. Infrastructure predictions succeed because they are built on frameworks and verifiable data points that can be tracked and measured. That gap, narrative versus framework, is the same gap between the investors who keep chasing predictions that never land and the investors who actually build systems that generate returns regardless of where the price goes. Price predictions in this space are built on 3 broken foundations, and you need to understand all 3. Foundation 1 is technical analysis used in isolation. Fibonacci extensions, Elliott wave counts, moving average crossovers. These are genuinely useful tools for identifying structure in a chart, but they cannot predict the future. A Fibonacci extension can tell you where a target might sit if the pattern plays out. Keyword: if. It cannot tell you whether the pattern will play out. In 2025, the pattern didn't play out for any of these predictions. The PI cycle top indicator never fired. Using a single indicator as the cornerstone of a price call is not analysis. It's hoping the chart agrees with your pre-existing conclusion. Foundation 2 is narrative extrapolation. XRP has utility. Institutions are coming. Regulation is clearing. Therefore, price has to go up. The logic feels sound until you examine the variable it skips entirely: timing. XRP's utility is genuinely growing. The institutional thesis is real, but virtually every 2025 prediction assumed the market would price that in immediately and aggressively. It didn't. The market operates on its own timeline, and no amount of narrative strength can override macro liquidity conditions, broader risk sentiment, or the mechanical reality of profit-taking at cycle highs. Foundation 3 is the one nobody wants to talk about out loud: audience incentive. XRP. YouTube channels are structurally incentivized to be bullish. Bullish predictions generate views. Views generate revenue. A thumbnail that reads, 10,000 XRP is actually possible, gets infinitely more clicks than XRP will likely trade sideways for 18 months. Nobody wants to hear that. The incentive structure of this entire content ecosystem rewards boldness, not accuracy. That doesn't make these creators bad people. It makes them participants in a system that rewards entertainment over rigor. But if you are making investment decisions based on entertainment, you are building your financial future on a foundation that was never designed to hold weight. Bloomberg's ETF prediction was right because every single input was verifiable. SEC filing timelines, precedent from prior ETF approvals, regulatory leadership statements, institutional demand data. Each variable could be independently tracked. Each one had a measurable outcome. The prediction was the sum of its inputs, not a hope dressed up as analysis. Compare that to the $10,000 prediction. What are the trackable inputs? What specific variables would need to materialize? When you try to break it down, you find there are none. The inputs aren't verifiable, they're aspirational, and aspirations don't compound. The difference between predictions that work and predictions that don't isn't intelligence, it's process. A framework says, here are the 5 specific things that need to happen for this thesis to play out. Here is where each one currently stands, and here is what I revise if any of them fail. A prediction says, I believe it's going to $10,000. Here's why I feel that way. Feelings don't compound, frameworks do. Standard Chartered got the price wrong, but their methodology was sound enough that when reality diverged from the model, they adapted, revised down, acknowledged the miss, moved forward with updated inputs. The channels projecting $20,000 never revisited their calls because the content had already been consumed, the views already banked, the algorithm already fed. So what do you actually watch going forward? 4 things, and none of them are price targets. Watch infrastructure milestones, not price charts. ETF launches, on-demand liquidity corridor expansion, RLUSD market cap growth, the Clarity Act's regulatory progress. These are the variables Bloomberg got right, because every single one of them is verifiable and trackable in real time. Watch methodology, not confidence. When someone makes a prediction, ask what inputs their model is built on. If they cannot name specific trackable variables, it is not a prediction. It is a guess dressed up as analysis. Watch for revisions. When a creator makes a bold price call and reality diverges from it, do they acknowledge the miss and update the framework? Or do they move on to the next thumbnail as if the previous one never existed? That behavior tells you everything about their process. And watch your own behavior. If you are making allocation decisions based on price predictions from YouTube videos or Twitter posts, this video is the evidence. Not one major prediction in 2025 was right. Not from any channel size. Not from any subscriber count. The approach itself is broken. XRP at $1.40 today has genuine utility underneath it. On-demand liquidity is processing real volume. ETFs are operating. Regulatory clarity exists right now. Whether the next move takes XRP to $2.80 or $8, or down to $1 or down to 50 cents, that's genuinely difficult to know. The investors generating yield from their holdings right now don't need to guess correctly, because their system works either way. The investors who came out of 2025 ahead were not the ones who predicted $5 or $10. They were the ones who understood the technical structure well enough to recognize when XRP was overextended. The ones whose portfolios were producing returns whether XRP was at $1.40 or above $3, because they had a framework generating income through both the peak and the 60% correction that followed. Predictions feel good. They feed confirmation bias. They give you the sensation of certainty in an uncertain market, even when that certainty is an illusion. The investors who break that cycle, who stop chasing the next bold number in the next thumbnail, and who start building systems instead, those are the portfolios that look fundamentally different 12 months from now. Not because they predicted the right number, because they had a framework that didn't need to.